I want to welcome everyone to the Audit, Finance, and Facilities Committee meeting today. And thank you for being here. We appreciate your participation. And we appreciate your hard work for this committee. I think introductions are okay. Everyone knows everyone. Jill, were you at our last meeting? I'm not sure you were. Jill, let me introduce Jill. We'll let Jill introduce Jill. Jill, I've known Jill for years in the finance world, but I would like for you to introduce yourself to these other commission supervisors, if you will.
My name is Jill Swinger, and I work for a local firm, Warren Whitney, and I've been a director there for 25 years and mostly focus on the nonprofit world. And I was the interim or contract CFO a few folks ago, prior to Dan. So for about a year and a half. So I was bridging the gap between a couple of other CFOs. So fairly familiar. It was really a team effort initially. I guess we came in about 2 months ago.
Yes.
And about a week before the audit was supposed to start. So it was a little crazy, but we got through it. I think Mark will attest to that. The staff did a great job. And I had another Warren Whitney person in here helping me just because it was my busy season. So now I'm going to be the primary contact until we find the replacement. So I'm happy to be here and happy to meet you all and be associated with this great organization once again.
Wonderful, Jill. Welcome. So good to see you again. Thank you for being with us today. Thank you. And Martha, it's my understanding, item 2, we have someone participating remotely. Is that correct?
Yes, Mr. Rhodes. So
Mr. Rhodes, good morning. Good morning. Good morning. What I would like to do is request a motion that the decision to approve or disapprove our external auditors participation remotely from a remote location, and it looks really nice by the way out there. Remote location in conformance rather with PlanRVA Commission policy for remote participation and the voice of the remotely participating auditor can be heard by all persons at the primary and or central location.
We can just
By
confirm.
voice vote. We can dismiss
Just
with that.
confirm that, yeah, we don't actually need a
Okay.
motion unless
We don't
there's
need
a
mo-
member.
Okay, I eliminate that. No motion needed. Can we confirm that? Can you confirm that, sir, that you are participating remotely so that everyone can hear you?
Yes, I'm participating remotely.
Thank you. That's confirmed now, and we can hear you well and clear. And hopefully you can hear us okay too. So thank you. With that, dispense item 2. Thank you so much. Item 3, administrative items, approval of the minutes from on page 3 from, let's sort of take a look at the minutes. Items 3A, B, C, and D, minutes from those respective times. See, did we approve those, Janice?
Those were approved at the last
They
meeting. Today
were
we're
approved.
approving the May 22nd.
Only the May 22nd. Let's get to May 22nd.
That's those, that's these.
Okay, that's okay,
Yes.
there is May 22nd, thank you. So, let's take a quick gander at these meetings. Let me look at first as well. Let's take a quick look to see if there's anything we think needs to be amended or approved. All right, very good. I'll certainly entertain a motion to approve the minutes as listed on page 3 and 4 respectively.
So moved.
It's been moved and properly.
I'll second it, but I
second.
wasn't here.
That's okay, well, I'll second, let me second it, I was here.
Yeah.
I'll second it, it's been moved and properly second. Any additional comments or additions? Hearing none, those minutes are approved. Thank you so much. I apologize because I didn't realize that till I looked at the schedule here. I'm still getting familiar with it, but thank you, Mr. Atkins as well. And of course, Mr. Schoenhauser. All right, item 3, let's move to the work now. We've done item 2 and 3, let's move to item 4. The fund, and this brings up Jill along with Mark, commencing on page 5 of our program, if you will, action 5. And this is action item 2, the audit financial statements, opinion, and approval for our November 14th commission meeting. So, Mr. Swinger or Mr. Rhodes, which you like to go and how would you like to go?
Mr. Rhodes, I'm gonna defer to you and have you dive in.
Okay, did you want me to, do you want to share the screen and then I'll just put the draft audit up there and then walk through it that way?
That works for me.
I can do that.
Thank you, Martha.
I have to pull my tabs up, sorry. Okay, Mark, you just let me know
There
when you'd
goes.
like me to go.
All right. Can you see it now?
Yes, we see the cover page and the table of contents.
That looks like that's somebody else's because they're scrolling through, but I'm not doing anything. So,
Oh, are you sharing, Mark?
well, I thought that if I shared, then I could just flip through the pages and you wouldn't have to.
Yeah, please do. My apologies.
Okay.
I thought you were asking for us to do it. Sorry.
Yeah, that's all right. We're seeing the same thing. We're good. We're in sync.
All right. All right. So as we start, I believe the audit starts on page 5 of your packet, and I'm skip to page 7 of your packet, which is page 1, numbered 1 on the audit. That's the start of the opinion letter. And this is the standard clean opinion. So there were no findings or question costs that were identified during the audit. So other than that, that pretty much covers that. The next section that I'm looking at is the management discussion and analysis. This is where your staff, Martha and your staff, summarize the activity for the year. And so if I jump to the page of your handout, it's page 12, which it discusses the current assets, the statement of net position, and you can see there your current assets, capital assets, your lease assets. Lease assets were the new asset that was added last year. When you guys, with the new regulations, and new place, and so it's being amortized over the life of the lease, and so it's going down. And it's got a coinciding liability, so it's recording both the asset of your rights to lease the property and your liability for the lease itself.
Okay.
Okay.
Okay,
And then,
I see what that was. I got you.
Okay. What's the duration of that lease, Mark? Is it 20 years, 25, 30?
it was 10 or 15, was it?
15 years?
Office space.
The office space,
11
yes.
when we signed.
11 when we signed, okay.
9.
Okay, very good. Thank you.
Okay.
Mhm.
And then on the next page that I have up there, that's the statement of activities, is summarizing the project cost increasing by about 100,000, your revenues increasing by about a little less than 300,000, so that your net program revenue is positive. You also have miscellaneous income, which the vast majority of that is your GASB 68 adjustment. And we'll see that on the actual statement of activity broken down. So
Could you elaborate on GASB 68? We have some people, some members who may not know the GASBs.
Okay.
Government, or is it general?
government accounting standard.
General government accounting standards, yeah, GASB.
So
It might be helpful to be as explicit as possible for our members here. I live in the world of FASBs, but I also like GASBs. Okay,
so for this adjustment, this is required because of the VRS retirement plan that
yes,
Lincoln has. And so it is tracking whether or not you're funding that retirement sufficiently. And so if you have a liability, it's basically saying that you need to increase your funding. If you have an asset, then it's saying that you're better than on track with funding it. And so each year there is an adjustment, and it's always 1 year behind because your actuary is looking at, in this case, June of 23, and then giving you your adjustments, but you're auditing June of 24. So
Okay.
it changes as the market changes, basically, because it's investments. So your return on your investments, if you get real good return, then you're going to have less that you have to pay in. So.
And where's the Mark, I don't want to slow you down. Where's the footnote to this on the back? There's a footnote that should outline this. What's that footnote number? Do you know?
So that starts on,
Note 6. Yes, note 6. I'm sorry.
yeah,
And note 6, page 40, which you said you'll refer to later. All right, excuse me. Go forward. I'm sorry, go forward.
yeah, that note lasts about 10 or 15 pages. So, so that was the statement of activity. Just jumping to the next page. It breaks down the, oh, that's not what I wanted. I wanted that. More detail for the change in your fund balance, the expenditures and your revenue breaking down. Increases in both revenue and expenses, and a net positive of revenue over expenditures this year for the fund balance, showing that your fund balance is now sitting at 1.2 million.
Thank you. On page 14. At the bottom is what he just alluded to.
Sure.
Yes, sir.
Yeah. Is the fund balance a percentage or is it a flat dollar amount that we're looking for?
Flat.
Flat, isn't it one, is it 1
1
million?
million. 1 million. We're evaluating that for future periods to where it should be. That's one of our goals as a committee.
Okay, great.
Be where we need to be.
That's where it's headed.
Thank you. You're right.
Thanks.
Yeah, we've been there for years. Thank you.
Okay.
And good news, great news here. I think we ought to highlight it. This is positive. We have excess of revenue over expenditures, a significant turnaround if you look at it, from a negative 235 to positive 72. That's good news. Thank you, Jill.
And I'm sorry, I will just note,
Martha, go ahead, any comments?
in 2023, that excessive revenue over, or really excessive expenditures over revenue of 235, that was planned.
Okay,
And that was due to the office relocation.
that's right.
So I just want to sort of point that out, that we have been, from an operating standpoint, contributing to the fund balance year over year for the last few years. That particular transfer from the fund balance was budgeted and planned for in conjunction with the office relocation and furnishings and build out.
Yeah, absolutely. Thank you.
Mr. Chair, I do have
Yes,
a
sir.
question.
Mr. Atkins, please.
I'm not sure what a bad debt expense is.
Okay, great question. I'm gonna let the auditor answer to it. I just finished teaching that. It's called bad debt or allowance for bad debt sometimes. And of course, that's another term too we use. Yeah, bad debt, but uncollectible receivables. But would you like to talk about that, or you want me to talk about bad debt? And bad debt is, in this case, $39,000 in 24 versus 23,000 in 23. In other words, bad debt's when the debtor doesn't pay. The creditor, in this case, doesn't pay the bills. And what is it specifically, Martha? Something was not paid to be recorded as a bad debt. A debtor didn't pay.
That's fine, I understand, we don't have to dig that deep, okay.
If I'm not mistaken, those are state Homeland Security grant unreimbursed expenses, but I wanna confirm that with Mark, with
Okay.
the schedule.
Right. So there were items that were billed for that grant that were denied. And so they recognized those it takes a while for them to finalize their approval. And so these are items that have been on the books for a while and identified as not collectible.
Yeah, of a certain period. And GASB does not allow you to carry debt that is not collectible. That's prohibited. And so it's got to be written off after a reasonable period of time when it's deemed uncollectible.
So that's a pretty significant line item that we weren't able to, do we know, do we know why that wasn't?
Well, we have to
why
dig a
we weren't
little
able
deep
to-
into the schedule. Mark could maybe look at, or Martha could look at the schedule. I don't have it in front of me, but they did. Oh, you just mentioned Homeland, something about Homeland.
Yeah.
Martha, you just mentioned that. Please elaborate.
Typically, it's related to the Department of Emergency Management's policy not to reimburse indirect costs. And so we have been in sort of a persistent effort to convince VDEM to comply with the federal guidelines regarding recovery of indirect costs.
What would an example of an indirect cost
Um,
be?
Yeah, so I know we'll get into this in the footnotes, but essentially our indirect costs are those expenses that don't make sense for us to allocate directly to grants. Think about big expenses like rent or our parking fees for staff, so we don't itemize every time someone swipes in and out of the parking garage or allocate the rent expense every month to every specific grant. We calculate the total cost of those expenses categorized as indirect, and then we, by percentage, apply them to our direct allocated costs. So when we bill salaries, time essentially of staff members that have charged to a specific grant, we add a fringe rate that by formula applies our leave and insurances and retirement benefits, those fringe benefit packages by percentage, and then we do the same with our indirect costs. And it is the opinion of the Virginia Department of Emergency Management that indirect costs are not eligible to be reimbursed under their grants. We have a differing opinion, but as the funder, they have continued to decline to reimburse us for those costs.
Thank you.
Thanks. All right, thanks, Mark.
Mark, did I get that right?
Yeah.
Well enough?
Oh, yeah. No, it's part of the cost of doing business, but they're not wanting to reimburse you for some of it, so. Okay. And then I don't know if there's anything else on the financial statements themselves. I was gonna jump into the footnotes as far as I mean, the retirement footnote is your GASB 68, and like you said, it's it's a long, drawn out. If you're having trouble sleeping, you can start reading that on it's page 22 of or 21 of the financial statements, which would be page 28 in the handout. And like I said, it's about 10 pages long that tells you everything you didn't know you wanted to know about the retirement plan. And then we have a footnote at the end of the statements also that breaks down the activity for the past 10 years.
Yeah, one question, Mark.
I'm sorry,
Neil.
I'm sorry, as I was
question.
heading to there, one of the questions I had is, why does a lease amount show up as an asset? Because to me, that's just a bill. We're not gonna be able to sell this building, we're not gonna be able to do anything with it, but it shows up as an asset in our balance sheet, which would make people believe that we've got, I mean, it's really a cost. Just again, I'm not an accountant,
Okay.
never.
Well, Mark, you want to talk about the GASB that requires lease accounting, be an asset and liability?
You're not alone with your thought process there, but this was a really kind of get things in line with international accounting on the for-profit side, but then it was determined that the asset, or rather the liability, was always in the footnotes. So you'd have to go back and look at your footnotes to see this liability that people had, and they could have a 10, 15-year lease, and it wouldn't be on the balance sheet. And so they thought that it would be more transparent to bring it forward to the balance sheet, but you can't just bring the liability. You also have to show that, well, as the leaseor, you have, or leasee, you have the right to lease it, and so the value of that is put as an asset. So in essence, they're offsetting. They're not exactly offsetting because the asset is just recognized evenly throughout the life of the lease, whereas the liability is assigned a present value and then recognized over the life. But the short answer is yes, there's a lot of people that ask the same question. But because it's a required presentation now as of last year, this is being shown on every governmental audit.
Yeah, yeah, and it's calculated based on the present value of cash flows in that lease. That lease notes cash flows each year, how much money we paid the leaseor, and so as a result, that shows the present value of those cash flows. That's accumulation of it. Thank you. Thank you, Mark.
Thanks.
Thanks for the question.
And then just, you can skip all the way to page 42,
Okay,
and that would be your start of your footnote for the right to use asset.
yeah,
I mean, it's 42 in your handout. It's page number 35 of the audit itself. And so the right of use asset is just presented there.
there it is.
And then on the following page, your liability for the lease is broken out.
Yeah, absolutely. Thank you. As Martha noted, 11 months and 11 years and 6 months. So, good term. I had asked that earlier. Very good. A discount rate of about 3.85%. Thanks, Mark. Continue on, please.
While we're on that page, the fringe benefit allocation calculation is shown there. So this is in the billings for these grants. This is our fringe rate.
Okay,
Moving in the future. And then the very next page is the indirect rate.
rate, yeah.
You guys had a lot more direct costs this year, so your direct rate dropped. Or rather, your indirect rate dropped because you had a lot more direct costs associated with programs.
This is pretty significant.
Go ahead, Martha. Go
Our
ahead, please.
fiscal 2023 audited indirect rate was 59%.
Yeah.
That sounds about right.
And so to jump from 59 to 37 is fairly significant. From a history perspective,
That's about right.
it was in the 70s when I started here.
That's about right, yeah, when I was
And,
here, yeah.
I think when Mr. Crum started, my predecessor, it was over 100%. So we have been, over the last 2 decades, really working at, you could argue, building some efficiencies in our billing. And so this is significant. I don't know that from an accounting perspective, it's viewed this way, but I had set sort of a mental target of my own that 45 was where I was hoping that the agency would be, and so 37 is in excess of that goal. So we are gonna be watching this very closely this fiscal year to make sure that from an operation standpoint, we don't really want the indirect rate to be fluctuating or moving too much. So this is gonna be, kind of a new standard set for us in the agency. Similarly, on the fringe rate, it's held fairly stable, but as you can see from what comprises their leave wages, that's directly tied to our leave policy and the wages that our staff earn. So that's, a figure directly connected to the salaries that we pay. But the health insurance and the pension, well, health insurance is a cost that's essentially beyond our control from many respects. Our really only lever that we have to control that is in a decision, if we ever were to make it, to try to participate in the marketplace. We currently, and have continued to make the decision to remain in Virginia's local choice program. I think generally speaking, the best practice there is that helps insulate smaller organizations from market forces that drive the ups and downs of cost of offering insurance.
Yeah,
And it hasn't appeared that any other alternative is more cost effective for us than and we have actually, Diane, correct me if I'm wrong, I think the last 2 fiscal years, we've actually had either a modest savings and or just a
It's
kind
kind
of
of flat.
stayed the same for health insurance benefits, so we've been really fortunate there. So that increase really only has changed in the last 2 years relative to number of personnel enrolling as opposed to rates. And then pension and payroll taxes, as you all know, is directly again proportional to wages. So I just sort of wanted to talk about that a little bit because the 53%, this is a ratio that's really difficult from a management perspective to move because of market forces.
and Martha's absolutely right. This is one cost that in local government I've found we cannot control that well. It's been difficult for years,
Yeah.
as you know, even at the inception.
I-
Just healthcare has always been a challenging one. And the Affordable Care Act came into fruition in 2014 or whatever, so. But it's been a difficult one for any government to control, as y'all know. I know I have from Chesterfield's point of view. I said, that was the one line item I can't get to, and I wanted it, but I can't get to it.
I think
That's
that
one line item.
I remember when it used to be that we thought about fringe as around 35%,
Yeah,
but that's been 15 years ago.
yes.
So I mean, I just wanted to
Fringes
sort
have
of call
risen.
your attention that 53.88% is fairly consistent year over year for us. It, you know, it might move down. I think maybe it's been as low as 49, that I can recall, but typically it's in like the low 50s for us.
Yeah, that's correct, Martha. Thank you, Martha. You're absolutely right. That's one that's difficult to control. And while we're still here, Mark, I wanna eliminate that on page 41, we're talking about the lease liability. Here you will see that there's recorded as a present value of future minimum lease payments, which I call cash flows in there. And you'll know I think it's Gatsby 87, not 68, Mark, is that correct? I see 87 in the footnote. Gatsby 87, huh?
Yeah,
On the footnote, it should be Gatsby 87 more likely, because it came a few years after FASB's lease arrangements, okay? So it's Gatsby 87. Can we confirm? Can we confirm that?
yes, that's 87. The lease liability is 87, yes.
Yes, very good. Okay.
68 is for the retirement plan.
Retirement plan, thank you, all right. I was thinking, I guess I'm cross. Yeah, I have one question while we're on this page. Assessments for participating localities, note 7. That's based on population, is it not? Still based on population?
Yes.
And
Yeah,
it's my understanding that Chesterfield should be more than Henrico. Can we confirm, I would go back and confirm the population base, or are we looking at a different year?
So
or
I'll explain that. Chesterfield's population is larger, it is the largest in the region. However, when we calculate our assessments, we exclude the Tri-Cities portion of the county from the population.
Okay,
So I can actually show that. When Mark is done displaying his screen, I can show you
Okay.
how that works.
Yeah.
But that's why the Henrico contribution is the largest, because the population on which we base our member dues for Chesterfield excludes that southern part of
Which is
Chesterfield
Cradle.
County, which is part of the Crater.
the Cradle,
Yes.
planning district, because we're part of 2 districts, we're part of Crater, and we're part of, PlanRVA.
And I would note, we do that exclusion of population in Chesterfield, we do not do that exclusion in Charles City.
I know that.
I thought you might, so, Yeah,
Okay, very good.
so it's the whole of, and I don't have an explanation for why it is that way and has been for my tenure.
Okay, yeah, because an average observer may not note that. It almost requires a sentence, if you will. Note excludes Crater from the PlanRVA region that Chesterfield participates in other words. Because the dollar value, it's about $6,000, not material, but that should be noted, or probably say it.
Do you want us to update that note 7 to
Yeah,
communicate
I think it
that?
would be more appropriate. I think for readers of the footnotes, that would be something that they can say, oh, why is that the case? Because on the average, we know Chesterfield has a higher population, but what we don't also know is that Chesterfield's part of 2 planning districts.
Mark, can we work together? I can provide
Yeah.
some language to incorporate before it goes to the full board.
That's fine.
Okay.
Good, I think that's more explicit. And transparent. Thank you.
Mr. Chair, I had a question on indirect costs would now be a.
Yep, let's
Ask that or
go,
read it.
yeah, let's go back to footnote 11, Martha, okay?
Yeah, sure.
How about note 11, indirect costs, your question, Mr. Stonehauser?
Yes, thank you, Mr. Chair. You mentioned that the last 2 years, indirect costs have been something, and I imagine it's very complex when we're dealing with, I guess the question is, have we seen an increase in indirect costs as it relates to the work that we do with the CVTA? So there are a lot of different things that, like, is that all captured?
It's a good question. It's, this is the thing that, I'll just confess, I am equally happy that our rate has climbed down, and, it is important to me to understand what drives that. The total indirect cost, so when you look at note 11, and Jill, I'm looking at you to sort of help me here, but the total indirect cost, that 1,043,000, that is relatively stable. So the actual the actual number of accumulated indirect costs year over year is about the same. The difference is that the total direct labor and fringe, that 2.8, that number increased, which is what made the rate go down.
By almost $1 million.
That's right.
So it was a huge impact because we have more direct costs, which is good, because that means that we're charging our time to grants and not having indirect. If that's what you want, ultimately.
So essentially, I view this in some regards as a measure of efficiency. We don't wanna go too low, because then we're not applying a rate that covers these legitimate costs to operate the organization through our grants. At the same time, we don't want it to be too high, because applying that, significant indirect rate eats through our grants faster, right? So there's a balance, a tension there. The increase that Jill's speaking of, the total direct labor and fringe, is in part because we've gotten better at assigning staff to grant-funded programs as opposed to outside of those, right? We've been talking about that for years.
Yes,
about
we
making
have.
sure that our
Thank you.
time
Yeah.
is spent in the right places. The other piece of that is driven by CVTA. Because we have this relationship with CVTA, because the CVTA expenses that we incur on the CVTA's behalf is helping to drive those direct labor and fringe costs. So CVTA staff, Mr. Parsons, is still running through essentially that bottom line number, as well as the operating expenses that have increased due to CVTA being co-located with us.
So I was completely tracking it on board until that very last sentence.
Okay,
Why would CVTA salary be in ours? It's a completely different entity.
Mark, do you wanna speak to that?
Well, there are direct costs associated with them that are being applied to those. So if you were to back it out, you're still having the indirect costs. You have indirect costs associated with their work. Yeah.
Sure, I get that. Mark, I'm speaking specifically about, let's just focus on Mr. Parsons' salary. So this is the first year that his salary is CVTA only, because it's the first year we've had a director. He was working with PlanRVA previous, so maybe it'll catch up next year. But this was the first year that CVTA had their own employee. So why would their employee be showing up in our books? If they are, maybe they're not.
So they're being identified as a separate project, basically, because they're still utilizing the rent, the expenses, the indirect costs. So those indirect costs are being utilized by them. And so their costs are part of your direct expenses. And so
I would agree with that. I would agree with all that except for Mr. Parsons' salary. That should be coming out of CVTA books. And if and I would bet, since I'm on the finance committee chair there, that it is coming out, so it's being double counted potentially.
Actually, we charge a fee. We charge a fee for that, as you well know.
Yeah, but
A
not,
fee for providing RVA staff and services to include staff at PlanRVA.
at PlanRVA, yes, but not at
PlanRVA, yeah.
CVTA. Maybe it's just something we can go deeper on. We don't have to.
Yeah.
I mean, I had the same questions,
Yeah.
in trying to sort of, dissect this, and I think what I heard, our auditor say is, yes, while the CVTA, engages PB mayors for their audit, and those expenses are audited on the management of the majority of the CVTA's funds in the Chesterfield County accounting ledger, it is still recorded here for those direct the operating expenses that we incur on the CVTA's behalf and get reimbursed for, and so
Again,
from an account, yeah,
I agree with the operating expenses piece. It's the salary piece that.
yes, I had the same question, and the response was that given the fact that Mr. Parsons still occupies his office space inside our office, it's appropriate to continue to include those salary costs here, but we can,
I think we just need to look that it's not double counted.
understood.
Okay.
Okay, good. And we've added employees this year as well, last year, by the way. We've added employees as of the spring, correct? Some different.
Yeah, I mean,
Really?
part of the, only a piece
Direct
of
labor.
driving that rate and that, the denominator, right?
Yeah, denominator, yes.
The denominator increasing is, only a piece of that is driven by that, and it actually, I think, Mark, you did the math for me even, it doesn't really change the rate that much. But it's a driver, not the driver.
Okay.
Yeah.
I don't
Right,
know if I'm saying that,
okay.
but
We'll make sure.
I think what I can do is flag it for Mr. Parsons, because I am not up to speed on the status of the PB Mayor's audit progress, but I presume that it is also happening right now. And so I can flag this for him to make sure that we're not,
Just that
yeah,
I'm sure it's all,
make some of
from an accounting perspective, for sure.
Yeah.
Thanks.
Yeah, we'll work through that. Thank you for that, appreciate it. Mark, if you would please continue. We'll get back with that question, okay?
Okay.
Thank you.
And then on the next page that in the handout is the budget compared to actual, going over and under,
Okay,
a surplus of 50,000 compared to the budget,
yeah,
and reconciles back to the change in net assets for
okay,
net position.
okay.
Okay, and
Mark, can I ask you a question?
yeah,
Please do.
Just kind of for my own, just to go back to your comments earlier about the GASB 68. So when I look at that GASB six, at the bottom of the schedule of revenues and expenses on your page 38, when I look at the GASB 68 net adjustments of 187,442, you made mention earlier, I think I heard you say if it's a positive number, it means that we have sufficiently, more than sufficiently, at least as of June 30, 2023, funded our pension liability. So if it were a negative, that would be an indicator that we were behind. Is that, did I
well,
hear you correctly?
not what it's really looking at. That was more in reference to your net pension liability itself.
Okay,
which they're calculating that your net pension, basically you have a pension liability of 448,000, which is just part of the changes that come out of this GASB 68. So they identify what your liability is. They also identify what your deferred inflows and outflows are. And then the net change is this GASB 68 adjustment of 187,000. So really your deferred liability associated with GASB 68 dropped by 160,000. And let's see.
Where are you?
Well, I'm just looking at, okay. See what's the easiest way to do that. So here on, I guess it's probably page 18 in the handout, page 11, and you're showing your deferred outflows associated with your pension liability itself, and your deferred inflows. So,
Okay, yeah.
oh, I'm looking at I'm looking at the wrong work paper.
You'll see a
What the statement was.
141, 308.
But if I go,
Attached to footnote 6, change in net pension liability shows you the changes. Page 2, that's 187, 187,442.
yeah. So your pension liability, if I look at your MD&A, your pension liability dropped by $140,000. Your deferred inflows, also a liability, dropped by about 25,000. And your deferred outflows were 25,000 higher, but comparable to the prior year. So they're calculating that your liability is going down by the pension liability. And so that impacts the rate at which you pay into your VRS also, because they're trying to identify, what you need to pay in to be on track with funding it.
So we would expect that to go down based on
Expect that-
this.
Yeah, in those years that the investment market is doing well and your return on investment is going up, then yeah, I would expect your liability to go down. Would flip the other way when the investment market's going down.
Okay, thanks.
Okay.
I guess it's a mental note for me that we've enjoyed the markets doing well for a long time. Because I don't recall an audit at this agency anyway, and maybe even long before that, that we have seen the opposite.
Right.
PRS has been doing quite well for a while.
The employer rates did go down this year.
Let's do the
So
investment.
I'm sorry, I didn't mean to belabor that, but it's just it's one of those forces that we don't have control over, but impacts us.
Yeah,
So
absolutely.
it's just something to be paying attention
Absolutely.
to. Sorry, I didn't.
That's
I
okay.
didn't make that-
No, that's all right.
not
Take
too
your
long
time.
of it.
That's okay. That's what we're here for. I appreciate that. Yeah. And
Okay.
I see net amount on page 11.
So speaking of the net pension liability, we have a 10-year
I'm sorry, I didn't realize we were moving on, Mr. Chair, can I?
Yeah, we have another question.
I apologize. So again,
Mark, another question.
I'm back,
Slow
so,
down.
yeah, right.
Okay.
So can we talk a little bit, and again, if this is not the right time, Mr. Chair, because you've already discussed budgets.
Yeah.
But I'm a little, I'd love to understand some of the numbers under the expenditures. Our salaries and wages came in under what we thought they were, to the tune of almost $250,000. Which you would think would correlate to the employee benefits and taxes.
Okay.
That went up 55%, which is significant. So I'm just curious, can we please talk to that?
Which line item you
So
referring to?
I'm under expenditures on page 38.
38, okay.
Okay, so if
Part
you
of the
look-
Salary and wages.
Salary and wages came in under, we expected 2.2, came in at 2. And we expected employee benefits to be at 722, came in at 1.1 million. So how is it that our salaries and wages went down, but we paid more out in benefits and taxes? To the tune of 55%.
I think, if I'm not mistaken, employee benefits and, no, excuse me, go ahead, Mark.
I was going to try and look directly at the budget itself to see the components that make it up so that you're trying to compare apples to apples.
Great,
And
thanks.
pull that up. But
I was gonna ask, are leave wages included in employee benefits or are they in salary and wages?
the leave wages, let me double check that.
And again, we don't have to answer all the questions here, but before we bring it to the full commission, we would probably be a good idea to understand, because that's, you would think they would be correlated, if they would go down. If you're not paying as many salaries and as many wages, you'd think the benefits for them would go down as well.
Okay, no, I'll get that answer.
That's a great question, thank you. Thank you, Mark, appreciate it. Any other questions? I'll go ahead and proceed with the comparisons, if you would, actual versus budget. Anything else you want to point out there, Mark?
No, I'm just identifying, I'm just showing the changes and really what questions you guys may have.
Yeah. Advertising dropped, budget versus actual, it actually was below budget, the actual was a lot higher than budget. Actuals were 109,600 versus actual of 185,000. We had a decrease of 75,000 in advertisement. That might be,
Actually, wouldn't it be the other way?
Yeah.
We
that
planned
seems-
109,000,
we planned 109,
we spent 185.
on 85, so it should be, there should be an increase, you're right, in your,
Well, it's identifying as an unfavorable versus.
yeah, unfavorable versus favorable, yeah. So it is unfavorable.
Yeah.
Unfavorable would be a negative, that's correct, with brackets, correct.
In answer to your question on the salaries, almost $400,000 of the employee benefits and payroll taxes is leave payments.
You know, that was in my mind, leave, but that's been a significant issue over the last few budget cycles, you know, leave. When employees
But
take
that's something we control and should be able to calculate.
No, you can't
Budget.
control it because you can calculate, but you can't control when it's taken, because employees take it as,
Yeah, Mark, is it fair to say that,
oops, I'm sorry.
how do I wanna ask this question? The two combined, it's probably more helpful to look at the two lines together for purposes of comparing budget to actual. Because the distribution, is the difficult piece to predict based on what leave is actually taken
Right.
in a given period. I think we continue to try to get better at that, but it still is a variable that we can't
It's
control.
challenging, it's
So our
challenging.
policy should be able to give us some, again, I don't remember what they are, but You know, and on our organizations, you can only carry over so much, and you have to use so much in a year.
That's correct.
Because that's a wild fluctuation, that's a big, for an organization our size, that's a significant fluctuation in leave. I don't even know how you get your work done if people are taking off 55% more time than you would anticipate. Do you know what I mean?
Yes.
You both like, yes, I live it every day, you know, so.
I don't know, again, from an accounting standpoint, how much of this factors in. I do know that we've had conversations more recently about trying to align our carryover policy with the fiscal year. So currently the cap and the deadline align with the calendar year, not the fiscal year. And most of that is driven by the natural flow of when employees want to take leave.
Sure.
You know, fits a little bit better with the calendar year, but it makes it difficult to be able to plan, particularly at the onset of the fiscal year, and then as the time goes through, about how that leave is gonna get scheduled and actually hit.
It may be
So-
interesting to go back and look at these audits, previous years to see if if it's typically this,
Yeah,
or maybe if this was an outlier year.
I do think correct me if I'm wrong, Mr. Holland, but
I
from
would-
last fiscal
yeah.
year, I think Dan was starting to build a bit of an analysis around that, so that we
Yeah.
would be able to see those natural ebbs and
Those
flows.
ebbs and flows
When
and
we
the
see
leave
that,
taken, that was one of the bigger challenges, leave taken,
And so
and the
I think we
liability
have a
thereof.
template that we could, Jill, I think we could work together to
Okay.
provide for the finance committee for the future quarterly statements, to look at that.
Okay, great idea.
But yeah, I
Right.
agree with you, it's
And then that's the beauty of these, right? These are controls, they point out like, oh, we may need
Yeah.
to shore up some things here. I mean, that's why you use this tool.
for sure.
Perfect.
Okay, very
I
good.
will say that looking at the FY '23 audit, it looks like there's not quite as dramatic, but 347,000 lower on salaries, 183
Higher.
more on benefits, so it does seem to be a bit of a thing, but yeah. I mean, there's certainly a way you can start to forecast, and people know, usually within a couple months, they know when they're gonna take their leave, so then you can start getting a little bit better, but it's a little hard the earlier part of the year to do that forecasting.
Yeah, it's based on the ebb and flows of the leave primarily,
Yeah,
based on historical perspective. So- Okay, all right, and so the credits are unfavorable. Very good. Any other questions or comments on the budget and actuals? Any other questions?
All right.
Okay, Mark. Yes, Mark.
So then you were talking about the liability, the lease liability, not lease, the pension liability.
Pension
So
liability, yeah. 68.
the next page shows the past 10 years with the liability listed at the, near the bottom of portion of it, as far as, at one point it was as high as 900,000. So it has fluctuated over the past 10 years.
Which line item are you referring to, Mark? You said total pension lease liability ending in,
Yeah, the highlighted section there that,
right, down here, okay. Oh, commissions, okay, good. Gotcha. Yeah, I see 932, I see, I'm with you, 2020.
so,
014.
and then the next one is just showing your all's contributions as you're going in. Page 42 of the audit, so 49 of the handout is the statement of expenditure of federal awards, showing the $3.2 million of federal projects that you guys worked on during the fiscal year. The bulk of which being with the Department of Transportation. And in talking with them, they were pleased with the people that they're working with. They didn't have any problems, concerns, or findings for the for this year, this period. So And the last couple pages is our opinion on the internal control and compliance, which is a standard clean opinion, and the compliance for major programs, which is a standard and clean opinion.
Good. No,
So if there's anything else you want me to go back to, or questions that you have?
no, not now, but I appreciate your comment on internal control. No material weaknesses identified. And you mentioned, repeat what you said about Department of Transportation. You said that their work was pleasing, or they were very happy with their interactions. Could you comment on that again, please?
No, in talking to them, I've identified that they've been working with the people here for a number of years. They think that they haven't had problems with them. The information they get is good. Anytime they've ever had a question, it's out of the standard operations where they're looking at something, and so they may just ask a general question about something to get clarification, but they did not find any problems with the reporting or the allocation or the allowability of the expenses that are submitted for reimbursement.
Very good. Very good. Thank you for that comment. Other questions and comments relative to the audit? There's a lot of historical data in here too, as we see. Let's take a look at that. 2020 is 2023. Okay, yeah, and I see we have it here, Martha. If you look at was it in Ryco and Chesterfield, we're looking at adjusted populations and therefore adjusted assessments on page 63.
Yeah.
So that's a good piece of information, and that footnote would help tie that in.
Well, that, I'll just note, that is not part of the audited.
No, it's not
financial
part of it, but it is.
But yeah, it's part of the agenda for today for item 6.
Okay.
Do you want me
very
to
good.
stop sharing so you can look at that?
Okay, any other questions on the audit? Anything you have, Martha, do you like to ask or comment on?
No, I mean, I wanna say thanks to Mr. Rhodes for
Yes,
the work
sir.
that he's done. We went through this process, I think, as Jill mentioned at the beginning, I mean, we went through this process, pretty seamlessly this year, and are really grateful for just the continued coordinated work together. The intention would be for the finance committee to make a recommendation based on today's presentation.
Okay.
To forward this to the full commission for presentation. As the target approaches for, I believe it's the Auditor of Public Accounts, and the state code requires planning district commissions to submit their certified audit by December 1st of each calendar year for the previous
Correct.
fiscal year. So we're on schedule to do that if the committee feels
Yes.
comfortable moving this to November 14th,
Recommendation.
full commission agenda.
Okay.
Mr. Chair, would you like, we did make some minor adjustments and
Correct.
some follow-ups. Would you like that as, so I move that we
Recommend
recommend this with the additions that we
additional
spoke about.
recommended adjustments and changes. And is anything in your explanations to the full commission?
And to clarify, the adjustment to the package that'll go forward is to that note 7 on the population.
Right.
Yes.
I think I have notes about presentation and sort of things going forward that this committee is gonna look at, including the fund balance, the $1 million threshold for fund balance, as well as the budget to actual on leave and wages, and the inclusion of the CBTA
Yes.
executive director salary in the direct cost pool.
Correct.
Those don't seem like those were edits to this
Correct.
package, but just
Just
topics,
topic.
yeah.
This topics, all right, wonderful, great. Thank you. It's been moved and I'll second it to move it on. All those in favor, sign of aye.
Aye.
Ayes have it, unanimous, so that, as noted. Thank you, Mr. Rose. We appreciate so much your help here today, walking us through this. A lot of information in a short time. Thank you, Ms. Swinger, for your hard work and helping us through to get to this point today. This is a significant part of our work, that is the audit of the organization and its financial records. So we appreciate that. So thank you both so very much, and thank all of you as well for going through this.
Yeah, Diane and Karen also did.
I know
They did the
they-
lion's share of the work.
I know Diane did, that's what I say,
Yeah.
that's what I'm saying to all of you, Diane inclusive,
Yes.
and Janice, thanks so much, I appreciate it. Let's move on then from item 4 to items 5, first quarter fiscal year 25, results. Ms. Swinger, page 56, as I understand it.
Yeah, do we have a hard stop at all? Are we? I don't know how
You wanna
fast-
stop? Well, no, we just get through the work we gotta do.
Okay.
I think in a reasonable amount of time we can do it. How much time do you think you want me
I
to take?
I don't need to take too much time.
You don't
I
have to.
just wanted to point out on the profit and loss, that, you know, we always put that last column out there that says how far of the year we through. We're 25% of the year through.
Yes,
On the lion's share of our revenue between the federal and the state funding, we're roughly about 21%. And then bottom line, for the revenue, we're at 25%. So we're right on track. It's just a little bit of the, you know, the categories, if you will. And on the expense side, again, no really significant outliers. There's a couple of expenses that we run through. Instead of taking 1/12 of our insurance and or one of the benefits, those were kind of hitting in July. And so there's a little bit of a higher ratio there on expenses by just those two items. But not a huge difference there. If you went to the bottom line of the expenses, we're at 26.5%, so just a little higher than 25%, but we're still on track, nothing too concerning. We end up with a loss of about $28,000, but I'm certainly not concerned about that at this point. It's just a bit of a timing issue, and we do have that trend that a lot of people take vacation in the summer months, and so you have a little bit of the not as much earned against your grants at that point. So that's all I would call attention to. We haven't spent any capital money yet. That's why that shows up as 0. So those were the P&L comments I wanted to make.
thank you, Jim. Okay, and I can see your reports here.
Yeah, and then there's just different ways that we look at it. We look at it in
Okay.
total, and then we look at it by major area, and then we look at it
Yes.
by grants as well, which we're not showing here, but
Yeah.
it's a little more, maybe you were looking at a bigger package on the quarterly. I tend to like to look things a little more condensed so you guys can get a bigger picture of what's going on. But we're, you know, I think we're in good shape for the first quarter. Balance sheet looks strong. No major issues there as well. If you saw anything that you wanted to call attention to, I didn't necessarily have anything to say about the balance sheet.
Okay, I see, okay. No, I don't at this point. And what we're showing, as of 9:30, for example, looking at the balance sheet on page 62, as you alluded to the profit and loss on page 61. And the loss, again, could you point out the loss again? I'm trying to look at in total by category.
It's kind of embedded in the fund balance. It doesn't show, we don't show it
We're
as a
not
separate,
showing,
as a
okay,
separate line item.
okay. All right,
Your non-spendables is really just your prepaids, which is saying, you know, theoretically, if you had to settle all your balance sheet up, but it's basically in the unassigned portion of your fund balance. That's where that loss of 28,000 is showing.
year to date.
Loss,
Okay, there we go. Okay. Okay, good. There we go. Yeah, that's what I thought I was looking at. I was looking at that, yeah, 28. Yeah, I see it right there. Thank you. On page 61, and on the balance sheet, we're showing comparisons to, this is, from changed from 6:30 to 9:30. We see, was it negative 117 in total cash and cash equivalents, right?
Right.
So our cash position is $278,000 as of September 30th.
Yeah, and I will say, since September 30th, I think we've collected on some of the billed receivables.
Well, the
So-
major thing is the fourth quarter TPO billing that had not come in as of September 30th.
So I mean, as you know, this is a snapshot as of 9:30.
That's right.
Not a reflection of where we are today.
Today, very good. All right.
Almost a month later.
Okay, very good.
So cash position is actually, if I'm not mistaken, Diane, a bit stronger.
Yeah, very good. Thank you much. Other questions and comments?
Yes,
First
just one,
First point.
yeah, so with if I'm looking at this right, Jill, the line for, on page 61, 7,400 program expenses, we're a quarter of the way through the year, yet we spent 99% of the money. Is that anticipated? Are we good with that?
Most of that is pass through, some of
Yeah,
that,
it's,
Or just,
but there's not a whole lot of, that's a little bit of a timing thing, you know, that.
so what
You're
comprises
good.
program expenses?
it's, if you go back to page 59 to the detail, it's a little bit easier to see what's
Okay.
included in that. You'll see, top third of the page, row 7400.
Oh, okay.
And organizational dues, so like Jill said, we pay a lot of the dues at the beginning of the year.
Okay,
Some travel, which is, kind of ebbs and flows, we see quite a bit of travel in the, fall and then again in the spring, not so much in the winter. So
Okay.
the lion's share there is in that pass through, and I will say that when we meet again after the close of the midpoint of the year, in January, when this body meets again, we'll have an update. The cycle of our funding, particularly around pass-through, doesn't operate on a fiscal year basis, unfortunately. So it's like those grants are just timing out right now, and then the new flight are coming in. So last week, we just got notice of the new awards. So we'll have a budget amendment that I think will shore that up a little bit and give a little bit of a better sense of pacing. And Jill, this is one of those things that I think we've talked about even when you were here before, about
Yeah.
how to accurately represent the pass-through, but then, yeah, when you look at everything rolled up, it distorts things in a way that
well,
makes it hard.
and
I
again,
think
as long as we're comfortable that, hey, that's where we're expected to be, we're
Yeah.
expected to spend it all in the first quarter.
Well, the
That's
good
great.
news is when your pass-through expenses are high, your revenue is offsetting in 100%. So
Yeah.
that, it's just, it doesn't have a bottom line impact to your P and L.
But
It's
yes.
just that it's honestly hard to budget pass-through. Cause you don't know exactly when
Should
you're
we call
gonna
it
incur
pass-through
those
then instead of
expenses.
program expenses? Because I think programs, I think about all the programs we offer.
Yeah,
I think that there's an opportunity to look at the organization of the account codes
Mhm.
and what gets rolled into something.
right,
Um,
right.
So that feedback would be
Maybe
helpful.
calling it out as a separate line item and not rolling it into program.
Right, because I think of programs, I think of programs.
Yeah.
Okay, very good, thank you, appreciate that, thank you, Jill, for your comments in that regard. If there are no other questions, we are, where we, program-wise, talk about that. Also, item 6, Martha, Ms. Schickel, you
Yeah.
mentioned,
Do you wanna-
dues or member dues or
Is it
something.
okay with the committee to just move the quarter one financial statements to the commission packet?
Yeah, I'm
Okay.
sorry, excuse me.
Okay.
So everyone prepared to move the first quarter presentation to the committee? Not the committee, excuse me, to the full commission.
Yep.
It's been moved, okay, thank you. And second, all those in favor, sign of aye.
Aye.
Ayes have it, it will be moved from the finance and audit to the full commission. Thank you, at its next meeting, tentatively,
Thank
November 14th, 2024. Thank you so much. Item 6, thank you, Mark.
Okay, thank you. Last page in your packet is
Okay.
a summary of our
Saw
fiscal
that early.
2026 proposed dues.
Okay,
So I'm gonna walk you through this table, cause there's a lot going on with this, but
Mistakes, okay.
as you can see, we've got our 9 member jurisdictions there listed on the left. As a point of reference, our bylaws and charter require that the Weldon Cooper Center's population statistics be the basis of how we assess our member dues. And so we're showing there that the 2020 population, census data population are the last decennial data that we have available. And so that's that first column. This is the reported 2020 census published. We do an adjustment for the population to be able to bring Ashland into the matrix. And so then we use that 2020 decennial census population to apply going forward. So you'll see in that second row, Ashland's population of 7,565 is equivalent to the reduction of Hanover County's population. So we don't
Double count.
assess Hanover for the Ashland portion of the county. We use that ratio for every year following the 2020 census until 2030 comes out.
Gotcha.
So that regardless of, what really happens in those two communities, we use that 2020 as the basis. And that's been the methodology that's been adopted effectively for our region. So that's that population adjustment there that you see below. And then we also do the same, sort of a similar adjustment to the Chesterfield population. So you can see there, at the bottom of the page, keeping the same Richmond TPO and Tri-Cities MPO percentage as the 2020 census. If you'll flip it over, Mr. Holland, you'll see for the Chesterfield total population, it's 364,548 in 2020. How it's split between the Tri-Cities and the Richmond MPO areas. So we take, we apply 87.69% to each annual reported population, and that's how we come up with what you see in the table on the first page. For your adjusted July 1, 2023 adjusted population there of 339,994. So that's how that works. Is that tracking with everyone? So that bolded column entitled July 1, 2023 adjusted population, that is the figure upon which we are basing the proposed member
You said
dues.
387 or 350, or was it 339? Richmond. You
So the
mentioned
87% of
okay.
the Chesterfield population for 2023 is 339,994.
Got you.
And so
Okay,
that's the
very
figure
good.
that we use. 'Cause
Okay,
we're
I
excluding
see.
that
I
Tri-Cities
see.
part of
I
your
see.
population.
Thank you, I see.
Yeah, so that makes it just coincidentally about the same population as Henrico.
Okay, so that brings us down to,
Yeah,
which is.
so that's why
which
those
is
numbers
correct.
start to look so similar.
Yeah, thank you.
So our total adjusted population for the region is that 1.1 million. And then you can see what we've got here is our traditional 60 cents per capita. That is the rate that we have been applying for as long as I can remember and beyond that. That is inclusive of the member dues to the commission as well as the TPO assessment. Those were effectively combined 2 or 3 years ago after the MPO boundary adjustment was made to encompass the whole of the PlanRVA region. And so it went from 55 and 5 to 60 cents, just a combined assessment.
Very good.
Our request for this coming fiscal year is that we adjust our per capita rate to 65 cents per capita. That second to last column from the right there shows what that delta would be.
65, I say, okay,
That would generate that additional 55,000 above and beyond the 60 cents per capita to bring our total from all jurisdictions, 65 cent per capita request to 723, and we've listed
Right.
the impact of that, so to speak. I met with the local government managers earlier this month to talk
Okay.
this through with them. Just sort of a high level, talking about the request that we were contemplating to bring that additional 5 cents per capita, really to support our regional indicators work and to continue to build the capacity in our data and analytics team. And their recommendation to me was that rather than putting a special assessment forward to make an adjustment to the base rate,
but it is,
so going from 60 cents to 65 cents per capita.
okay, makes sense.
The other thing that we talked about in that is that it would be worthwhile to go through an exercise to determine whether or not the way that we assess is the best way to assess. The managers agreed that that was a topic too large to undertake between now and November when we need to start to submit our budget request, but that should be an undertaking in preparation for fiscal 2027.
Okay, we'll put it on as a goal. You're talking 26, right? Go
Yeah,
ahead,
yeah, so
26.
today we're talking about, and so typically what we do at this meeting in the fall in anticipation of the November commission meeting, the finance committee makes a recommendation to the board with regard to the rate. And then I prepare budget requests to the jurisdictions based on that approved rate by the commission. The budget requests go through the local budget process, and that differs for each of the communities. In Charles City's case, I make a presentation to the board. In others, it's channeled through the planning departments. It just really depends jurisdiction to jurisdiction. And then we receive notice of what the local budget deliberations have resulted and bill accordingly in the next fiscal year. So this year, the request would be that we recommend authorization of staff to request that 65 cents per capita, which represents an increase of our member dues from 60 to 65 cents per capita.
Okay, reasonable. That sounds reasonable to me, 8.3%. Okay, that's 65 or 60, and that's what year 26 moving forward. So, any questions?
So Martha, what, you'd mentioned, you kind of breezed over something about data with the county administrators, so what's driving, so I'm not, talk me into this.
Sure. We've been powering our data team to date by grant-funded activities. And so where we can move our data and analytics program forward, it has to be eligible under those grant expenditures. So things that like you and I have talked about, to be able to have, team members' time available for local governments to help think through different population or demographic or housing market data, pieces like that. If we don't have a grant source to be able to fund that time, we either have to fund it ourselves or we have to pass on the work. And so this would generate that additional revenue to create an unrestricted pool that I'm anticipating using that 55,624 to generate that unrestricted pool of funds that can support our data team to have time available to build out our regional indicators data dashboard. But also to be able to be more responsive to local requests with regard to data and analytics. Maybe to say that a little bit more specifically, we've got a ton of transportation related data because we have funding to support that information. We don't have the ability to do some of the analytics that we oftentimes either want to undertake to support our programs or get asked to undertake in our jurisdictions related to some of the other priorities that our jurisdictions have. Land use, housing, environmental data, those other kind of program components.
Yeah, especially with housing being on an upswing as a significant national issue, is something we really want to work toward. And then transportation always, it's a big driver of our budget. So that's best, you may recall, you may not recall, but a few years ago, we did a special assessment due to our financial position. And rather than do a special assessment, this is a way to handle that, address that. We asked them to pay your dues and pay above and beyond.
Again, looking at neutral, it's like about $1,000, so it's not, it's not a major, I just don't, I'm just not a fan of just increasing these costs, especially when the population has stayed the same. We've come in, we're adding more to our fund budget, our fund budget. I feel like we should be able to absorb those costs without increasing the dues to the jurisdictions.
But actually, populations increased by 1 million, so regional populations increasing,
Which increases our revenues, right?
Yeah, that's why we want the rate to go there. Yeah.
But why?
Yeah, we need a
There's
rate
more
to
people,
address.
so show me that the increase in population correlates to more work for PlanRVA above and beyond what we're already adding. So if it's increased $1 million, then we're taking in more revenue. Why do we need to increase the amount of that revenue?
So I think I would say that the challenge to the staff over the last several years has been to go get more funding to be able to sustain the operations of this organization, and we have done that.
Absolutely.
And that shows certainly in our financials. I think the challenge with that and being driven, predominantly by our grant revenue is that the priorities become those of the funders of our organization.
Sure.
And so having the ability to increase the pool of available discretionary dollars helps us to stay focused on the needs of our jurisdictions. And it also helps us to make sure that we can continue to sustain the match obligations for these federal grants. And so I believe we're at a critical tipping point at that 60 cents per capita. We don't have the resources to continue to sustain a momentum to get more federal grants to come in or match obligated grants. We're capping out essentially at what we have available to match, dollars we have available to match through programs, but we also are limited on the discretionary dollars that we have to support our organizational priorities, which has been named as that data analytics category. So that's the case statement. I think in response to your comments, yes, we are demonstrating, stronger and stronger financial performance, but we're doing that with other people's money that brings other people's priorities into the operation of the organization.
But putting a blanket 5 cents on everybody, how does that change? I don't see that changes that at all.
what gives me the unrestricted revenue to be able to build out the data.
But it's still the same, like if you decide to take that money, let's say, you know, Henrico or Chesterfield has they don't need the analytics support that maybe Henrico or Charles City or Powhatan needs. You're still taking it from somebody, they're still paying more. It's not a sliding scale, I don't see how that changes. So I'm just missing that argument.
The practice has been that the localities don't receive services proportionate to the contribution that they give in. So,
And
the,
I don't see how that changes, this changes that. By
Yeah,
by adding it because we're still gonna only add 1,000, Chesterfield is gonna have to pay in the tens of thousands more, right?
Because the largest jurisdictions usually help smaller jurisdictions.
Exactly.
They've always been.
100%.
we've
Yeah,
always-
I-
So
This is,
that's why we-
this is
that's
me
why we pay
protecting
for
you.
it.
Yeah, so
This
so
is more of a
this-
tax.
No,
This
no,
is
it's
the
not,
point, I
no,
think.
no, I'm saying we're glad to help the region on behalf of smaller jurisdictions.
I think.
Henrico, Richmond, and especially Chesterfield,
The conversation with the managers, and now I understand what you're saying.
okay?
The conversation with the managers was that, yeah, it would be worthwhile to, over the next year, revisit whether that arrangement is still okay with everybody.
Yes, very simple,
Okay, so then why not have this conversation after that?
yeah.
Our hope was to be able to accelerate the work in the regional indicators, in the upcoming fiscal year as opposed to waiting
Sooner
until,
than later.
a year later.
And I'll
Okay.
just speak one more, and I'll stop, because you probably know how I'm gonna vote, but, you know, if we're saying out of a $5.7 million worth of revenue, we need to increase 5% or 5 cents to make $50,000, I kind of feel like we could find the money somewhere else. So this isn't like it's a $300,000 budget, we need 50,000, this is $5.7 million worth of revenue. That's all, thanks, Mr. Chair.
All right, and so, there'll be more discussion on this, as this is a year or two off, but,
Well,
go ahead.
maybe, I think,
What county
depending on
administrators I'm
the,
referring to?
well, yeah, I guess the question would be dependent upon, whether or not this committee wants to move the rate
This
increase
recommendation
forward
change.
or not, yeah.
It was your pleasure, you took it, and, my goal would be to move it forward, and recommend it as an increase for the purposes of the data analytics and more information, because of an increased population, therefore increased need and demand. So, yes, sir, Mr. Atkins.
With our limited, human capital there, we're gonna be more dependent upon PlanRVA. So, whatever they can do, expand, especially in the area of the dashboard, for better utilization of planning and resources. I'm in favor, even with our limited resources, with just modest increase for Charles City.
Okay, all right, good deal. All right, with that thought, I move approval. Can I get a second?
Second.
Okay, it's been moving from the second. I think we've had a good discussion. We'll continue to have discussion. All those in favor, sign of aye. Aye. No.
Aye.
Aye. Oh, it's unanimous, okay. I was
No,
waiting on
I'm sorry,
everybody.
nay.
Which one is it?
Nay. Sorry, I thought you said
That's what I
opposed, I
thought you were gonna say.
said, I am opposed to be.
Okay.
I understood you from the start.
Okay, I got, the motion carries 2-1.
Yes, and we'll
Okay.
include, we'll include in that, in
Okay.
the materials for the November 14th meeting.
Yes, ma'am.
The prevailing recommendation, but we will also make sure that it's clear that it was
Yeah.
there was a dissenting vote.
Yeah.
You don't have
I'm
to,
sure you'll speak up in the meeting as well.
You have the option. Okay, thank
well,
you.
you can get me there.
Okay, good, no problem.
Oh, okay.
If you don't mind, could I do a roll call vote just so that I can indicate in the minutes? that
Please
we
do.
did not have a
Janice, please
unanimous-
call the roll.
right.
Thank you, Janice.
So
Very
call me
kind.
out.
Thank you very
Thanks,
much.
Janice, appreciate you.
Okay.
Much love.
Roll call vote for,
Mr. Atkins, Chair Holland, and Mr. Spoonhour.
okay, that vote carries 2-1. Thank you very much. All right, thank you so much, Janice, for helping me there. All right, that's our last item. Any comments to come before this committee before we adjourn? Any questions? You concerned about anything you would like to hear or see? The committee has a significant amount of work I will share coming up. As I said, we're gonna be looking at a number of issues relative to finance, namely the fund balance, future fund balance, namely as well our banking relationship, as well as other issues, maybe including this and other concerns that may come forth. So we have a lot of work on our, the agenda for the future that we'll hopefully keep in mind, Martha. We've been talking about this since
Yes.
fall. Last, we lost a significant group of members of the Finance Committee. As you know, we lost, Ms. Peterson, Ms. O'Bannon, and there's a few other folk. We lost a lot of people with experience and expertise. So that will be forthcoming in the future, next year, that is primarily. But with that, I move that we adjourn.
I'm sorry.
Okay,
okay,
and
just
I'm
on
sorry.
that- on that
Please
note,
go.
I'll just
Share that.
quickly
Please share.
Cause I think it's important for all of you to know,
Mm-hmm.
earlier this month, we kicked off the recruitment process for, our vacant position in finance. We've titled it Chief Finance and Administrative Officer.
Mm-hmm.
Have received, an impressive set of applicants so far.
Wonderful.
We're reviewing those applications as they come in and have scheduled our first set of virtual interviews for first round this week. So we'll be kicking that off and, I don't think that by November 14th, we'll have an update on, progressing to a final candidate, but, certainly before the end of the calendar year, we hope to have
Sufficient.
our offer extended and,
Wonderful.
scheduled for timeline there. So just wanted to update you on the staffing piece of that. And again, with thanks to Jill and her team who's been supporting us for the interim and Diane and Karen who have been, those of you that were around during our transitions previously, I think, it's been, it's never easy for an agency of this size to endure a void. There's no question. But I think we've built a lot of great capacity in our team and that has really made sure that we haven't had any glitches or hiccups along the way. So thanks to you all for what you're doing to keep things rolling and moving forward.
Okay, thank you all. Again, appreciate your help, your efforts. Thank you so much. And with that, if there are no other comments, for the good of this body, we